Most people think insurance companies just collect premiums and wait for claims. The reality is very different. Insurance companies are among the largest institutional investors in the world. And understanding how they invest is essential if you want to build a career in institutional finance. In this video, I will walk you through the investment framework of a typical insurance company, why they invest, what they buy, and what constraints shape every single decision. Let's start with the basics. What is a bond? When you pay an insurance premium, that money does not sit in a bank account. The insurer invests it immediately because they know they will not pay most claims for months or even years. That gap between collecting premiums and paying claims is called the float. And investing the float profitably is one of the core business models of any insurance company. A large insurance company can manage an investment portfolio of $50 to $200 billion. This is not a side activity. For many insurers, investment income represents 30 to 40% of total revenues. Companies like Allianz, Prudential, AIA, or MetLife are, at their core, sophisticated investment managers. Now, how do they decide what to buy? Everything starts with the liabilities. An insurance company knows, with reasonable precision, when it will need to pay claims and how much. A life insurer selling 20-year savings products knows it will face redemptions in 2035, 2038, 2042. The investment portfolio is built around those future cash flows. This is called Asset Liability Management, or ALM. The goal is simple. The assets must generate enough cash at the right time to cover the liabilities. If your liabilities are long duration, your assets must also be long duration. This is why insurance companies are the largest buyers of long-dated government and corporate bonds in the world. So what does a typical insurance investment portfolio look like? The largest allocation, usually between 60 and 80%, is fixed income, government bonds, corporate bonds, covered bonds, safe, predictable cash flows that match the liability profile. The second allocation is real assets, real estate and infrastructure. These provide inflation protection and stable long-term returns. A typical allocation is 10 to 15%. The third allocation is equities and alternatives. Private equity, hedge funds, multi-asset strategies. This is the return-seeking part of the portfolio, usually capped at 10 to 20% because of regulatory capital requirements. That brings us to one of the most important constraints in insurance investing: regulation. Every insurance market in the world operates under a regulatory framework that requires insurers to hold capital against their investments. The specific rules differ by region. Solvency II in Europe, risk-based capital in the United States, and equivalent frameworks in markets like India, UAE, or Latin America. But the underlying principle is universal. Equities require significantly more capital than government bonds. Illiquid assets require more capital than liquid ones. This means the investment decision is never just about return. It is always about return relative to capital consumption. An asset that looks attractive on a standalone basis may destroy value once you account for the capital it requires. This is something that most finance professionals outside the insurance sector do not fully understand. And it is one of the reasons why insurance portfolio management is a highly specialized discipline, and a well-compensated one. Let me give you a concrete example. Imagine a life insurer with liabilities of $10 billion, mostly long-term savings contracts maturing in 15 to 20 years. The investment team needs to generate a return above the guaranteed rate promised to policyholders. Let's say 2% per year, while keeping the portfolio liquid enough to face unexpected claims and compliant with local capital requirements. They will build a core portfolio of long-dated investment-grade bonds to match the liability duration. They will add real estate and infrastructure for yield pickup. And they will allocate a small portion to equities and private equity to improve overall returns. But carefully. Because each percentage point in equities consumes significant regulatory capital, every decision involves 4 variables simultaneously: return, duration, liquidity, and capital consumption. That is the complexity that makes this role intellectually demanding, and why professionals with this expertise are sought after globally. From London to New York, Dubai, Mumbai, São Paulo, and Mexico City. If you want to work in insurance investment management, this framework is your starting point. Understanding ALM, fixed income markets, and regulatory capital frameworks is not optional. It is the baseline that every junior professional in this space needs to master. In this channel, I cover all of these topics in depth. From fixed income fundamentals, to credit analysis, to regulatory frameworks, with a focus on how they apply in real institutional portfolios. If this is the career path you are considering, subscribe and start with the videos on fixed income and ALM. And if you want a structured learning path, check the link in the description to our institutional investing courses.